Woo! What's up, everybody? Look at this. Quite the crew. Thank you for coming. All right. Yeah, I'm sure we're gonna have a few more people piling in over the next little bit, but we are gonna get started because we have lots to cover, but also we want plenty of time for you to ask questions because we're fully expecting lots and lots of questions during this session. We want the session to be interactive. So please, at any point during the presentation, if you're like, I don't understand what you're saying, I want to know more about why you're saying this is, a good thing or a bad thing, or it's difficult to negotiate. I want to understand this better. Please, either use the reaction buttons at the bottom to raise your hand so we can call on you, or you can post it in the chat. My colleagues Neil and Jonah are going to be trying to keep a good eye on it, and so will I, as best as possible. So let's dive in. Okay. So as you know, we've got a lot of great summit partners, especially on deal terms. We recommend you can reach out to some of the great folks over at Kircher. Those are for those in Saskatchewan, we all know them very well. But we've got great friends from API and CBRE, M&P, RBCX, BDC, Boast, Finergy Shred, SK Startup, Sharita, and Chess Club. Those are our best friends, and I'm not going to list off all the rest. But quick shout out to Emily, who is giving us some funding for our entrepreneur education series this summit. And of course, we've got a whole team of people doing it. So when we actually get into the negotiations, you're going to be talking to a lot of your regional leads there. So those are the names and faces I'm sure you already know. And I'm very happy to have Neil Vandebunte, our partnerships lead, here today, and Jonah Tetz, our operations lead, are going to be joining us to talk a little bit more about the fun stuff. So let's just get into it. What are the types of deals that you can do to get investment through what we call dilutive capital or dilutive financing, meaning you're giving up a share of ownership for capital in return? So there are essentially three types, kind of four when you really think about it, but essentially three. One where it's true equity, right? So you got common shares and preferred shares. You have what's called a convertible note. We're going to get into all of these ones and what they mean. I'm just starting high level. Convertible note, which is a special type of debt that can convert into equity. And then we call a special type in venture capital. This came out of Y Combinator. It's called the simple agreement for future equity, or the SAFE. So those are essentially the three types, and we're going to dive in here to kind of more about what each type is, how it plays into your negotiations, and what you should be thinking about when it comes to each section. And so for common shares, to kick us off, I'm going to pass it over to Neil to tell us a little bit more about what is common shares and kind of thinking about sort of the problems or the potential issues around getting a common share deal done. So
Totally. Well, really quickly, common shares is like an equity percentage. So each company, as most of you know already, is typically broken up into a number of shares, and that number can be variable. And in order to fundraise, people typically issue new shares in order to add capital into their organization. So if you're a founder, you would likely own the majority of the shares. You might have some reserved for employees or stocks or co-founders and stuff like that. But it's just based off your equity percentage. It's based off the number of shares that you own versus the outstanding number of issued shares for that corporation. In terms of fundraising, the general problems around an equity raise versus some of the other ones that we'll chat about later is it can be pretty complicated. It has it takes a bit of time, especially at the early stages, to really finally nail what the valuation and the dollar per share associated with that will be. There's also some substantial legal costs because there's a direct ownership into the company instead of like an ancillary related ownership. And also then there's a bunch of control terms because it's a long-standing relationship with your company.
Yeah, and then to that last point where I say sophisticated investors worry about economics and control, and we'll get into this a little bit more when we talk about the next structure, preferred shares. But essentially, with the common share deal, an issue that can happen is that I invest, say, $1 million at a $10 million valuation, and then you can go and sell the company for $5 million. You're really happy because you started the company with $0, right? And you got this company down to a $5 million valuation. You owned 90% of it, so you walk away with $4.5 million. I lost 500,000, right? So there's an issue there where there's a risk of this downside where I'm not even going to get my money back if you sell the company for less, right? And so then that's where the economics control part comes in. Is also in situations with startups, you don't have a board. Like a board would prevent that kind of thing from happening. But unless you're going to go through all the hassle of setting up a board as part of your common share deal, then that's not going to be in place. So then there's even less protections there for me in terms of a control, right? So not only do I not have like sort of the economics potential, but I also don't have the control there either, unless you negotiate all that. And then as Neil just mentioned, that all takes a lot of time, a lot of complexity, a lot of back and forth, a lot of just like ticky-tack terms that you have to kind of deal with and kind of wade through. And then there's a lot of legal costs with that. Yeah, and as mentioned, like the valuation is basically the number one thing you're going to have to negotiate. But we mentioned a couple other terms and documents there. Jonah, do you want to just quickly like talk a little bit about when they say unanimous shareholder agreement, side letters, what are we kind of talking about all there when it comes to these common sharing deals?
Yeah, for sure. So, like Jesse was saying, you're trying to align basically the startup, with the investors. Like, and it's really economics and control are kind of the theme of this entire meeting today. Is all these tools are really trying to align you with your investors that you want to go in the same direction. And so, I'm sure if many of you have incorporated your corporations, you've heard of a unanimous shareholder agreement where it's setting up the basic rules of the organization, things you can and cannot do. You can't just like boot somebody out of the organization or just end things or just create shares without talking to your investors, things like that. And then side letters are generally, I think, like it says here, like they kind of have some specific details or specific other terms that allow either you, the company, or like prevent you, the company, from doing certain things. So like, how you would create board seats, how you create a board. For example, the investors might want to know, like, get updates. It's really beneficial for you as founders to be giving updates to your investors in the first place. So you get additional funding from the future. But like, there might be some side letter that's like an additional clause to like just put that in stone, and maybe it's less of a like it is a legal thing, but also just like to create that like actual document of like, this is the understanding that we have between you, the startup, and the investor, and then yeah, all types of key decisions. That's kind of the main parts of the control terms for this side of things.
Yeah, and so I'll just say that in terms of those documents, as someone who's gotten these deals, often it's like 5, 6, 7 different documents that end up getting sent with all the different appendixes, different side letter, different information rights, all these other things that get put in there. And sometimes like the United Shareholder Agreement, this is like dozens and dozens of pages of paperwork, right? So that's why we want to make it very clear. It's like it's very complicated. I've talked to founders before when they've done their first share agreement, whether it's commons or preferred shares, which we'll get to in just a second. They're like, holy crap, this is way more paperwork than I ever thought it was going to be. So just bear that in mind, is that these deals
Complicated and expensive because you got
yeah.
lawyers for all those documents.
That said, people do like to do them sometimes. People like common shares. We do, and I'll get into it in our deal stats. We do a lot of common share deals. It happens. So with each one of these deal types that we're talking about, there are pros and there are cons. And what we're really trying to help you here is determine for you and your situation, where do the pros outweigh the cons and which deal is best for you. So preferred shares. So I kind of talked about, issues around economics. So this is where preferred shares comes in, and I'm going to pass it to Neil here to talk a little bit more about liquidity preference and what does that mean when we talk about preferred shares.
Yeah, totally. So broadly preferred shares are a way for investors to position themselves to give themselves as much leverage and control and establish a really strong relationship downstream, right? So as investors, we really want you folks to go out there and kick some ass and have to raise multiple rounds. So the issue with common shares is that your shareholder rights are typically minimized. So the other class of shares is preferred. So most investors, even at the early stages, will be angling for preferred shares. And then as part of their like whether they're VCs that have a fiduciary duty to their LPs or if they're just individuals that are trying to protect their downside, they'll work on something called a liquidity preference. So, in the event that your business does not exceed expectations and goes through a dissolution event, the liquidity preference allows shareholders to get a multiple on their initial capital that they invested as part of that sort of waterfall of repayment that happens when a company dissolves. So, folks can be really aggressive with that and ask for like really unreasonable multiples on their initial capital, which is something you need to negotiate. But most investors, again, there's a lot of subjectivity here, should be like looking for a low multiple. So I like a 1x, so trying to get their money back to protect their downside, or something like on the low end. So if you're seeing like a 10x, that's a super unreasonable demand, especially at these early stages, and they're just being jerks and trying to leverage the like positional power that they have over you. Because when a company dissolves, it goes through like a series of people who are subordinate and above each other in terms of how whatever money is remaining or assets get distributed to them. And this is a way for equity holders, which are typically low on that waterfall, to leverage themselves up that ladder so that they get some downside protection.
Absolutely. Yeah. So the important thing to keep in mind here is, as I mentioned with that previous example, so if I own 10% of the company and I invested at a $10 million valuation, about $1 million, but then the company ends up, dissolving and selling off all of its assets for $5 million, I would get my $1 million back at a one if I had a 1x liquidation preference, right? 1, 2, 3x is kind of the typical bounds of normality. You won't usually see a 3x until you're like really in your later rounds. That's often something that gets put in place as companies are heading towards IPO and the like. Really raising some of those bigger rounds. So, but we will see those like 1x liquidation preferences at our stake. And this is also important because often with convertible notes and safe agreements, which we'll get to in a minute, those convert into a type of shares. And sophisticated investors like those to convert into preferred shares. And part of the reason why, as I mentioned there at the bottom, and Neil mentioned this about the stacking, right, is there's what's called pref stacking, and then there's what's called a preference overhang. Meaning that my 1x liquidation preference means that my shares are essentially worth at least $1 million. Well, if you were to stack those sort of at least values up, right, and if that ends up being worth more than your company, that much value has to be created before you, as the common shareholder, right, a founder, gets any money, right? So you have to have more than at least $10 million worth of value in your company for you to get started to get the percentage difference. No, I don't know if I explained that exactly right, but I hope that makes sense, Neil.
Yeah, like the cliff notes is that founder shares are typically commons, and like along that waterfall of how things get paid out through a dissolution event, they typically are at the bottom end of that, right? So what Jesse's trying to say is that if investors get liquidity preferences that overarch the overall value of the corporation, then you could be left with $0 at the end. So like depending on the scenario, if it's like a wind down in like a gentle way, or if it's like a full out splash, then nobody expects money back. But if there is a wind down, you just need to be considerate of the fact that your priority on that waterfall is at the low end. So that's why investors are typically angling for that, and that's why you need to have good negotiation skills and be aware of what they're trying to do.
Question. Awesome. Teo, please.
Yeah. One second. You guys hear me? Yeah.
Yep.
Okay, yeah. So yeah, my question was actually, I think you mentioned something about earlier on, you mentioned something about lawyers. I don't think I caught that really, but were you saying that typically in this investments, seeing like they usually ask to have lawyers if you're doing the preferred shares?
Absolutely. Yeah. Common shares or preferred shares, you're going to need a lawyer involved. Typically, when you're dealing with a more sophisticated investor, like angel investor or VC firm, the way they'll structure it is that the legal costs come out. Like you end up paying the startup pays for it with the money that's being invested. So essentially, you're reducing the amount of money that you get in your company at the time of investment by how complicated you make it with your legal firm. So the more complicated you make it, the less money you get to just build your company with,
Okay.
right? And so that's part of the reason, like why we're explaining that is because that's going to play into the decision making that you're making on, is this actually worth it or not? Because if those legal costs are going to be $25,000 on a $250,000 investment, that's 10%. That's a lot, right? But if it's $25,000 on a $2.5 million investment, well, that's only 1%. Now that makes a little bit more sense. So that's where the math comes in terms of how you got to think about it with the lawyers.
Okay, but sometimes there's also like a possibility of finalizing the legal stuff after the like the competition runs out. You don't have to do like finalize all the legal stuff within this 2 weeks period. That's what I'm.
Oh yeah.
Okay.
Yeah, in terms of like with our what we try to end up by the end of this period is make sure that we've locked in sort of the high level terms in such that a lawyer could very quick, if we need to have a lawyer come in place, could like put the paperwork together like in a week after the summit because we've locked in all the main terms. Jonah,
You can
did
think of it
have
like a handshake, right? Like you're shaking on a handshake and agreeing on the terms basically like just verbally, or like, like this is kind of what we want to do. And then the lawyers are the ones who are like putting it in the legalese or whatever they need to do so that it's all as it should be. But usually the agreement for most of the terms are like preset. This isn't something that we're like, but that's not something you necessarily need a lawyer for. The lawyer is kind of just the one who's helping you paper that.
Yeah.
Okay.
Yeah, and we do have some lawyer friends both in Saskatchewan and across the prairies. Good Lawyer, Osler, Faskin, and McKercher are all great firms to go to. They have various rates depending on where you're at, and yeah, they're different checkout. So, in terms of like other key terms with preferred shares, we mentioned valuation. Is going to have to be determined here as well. Same with common shares. So this is often a difficult conversation, and we'll get to why people like to kick the can down the road with notes and safes in a minute. But essentially, yeah, you're selling real shares. You got to set an actual price, and you've got to negotiate and get all the other paperwork in place. There's 6-7 different documents that get pulled together for a preferred share deal. And then I'll mention the importance here. We talked about what the liquidation preference is, but we've got participating versus non-participating. So the easiest way to understand this is if I'm participating, that means I get my cake and I get to eat it too, right? I literally get that. So I get, not only do I get 1x my money back if I have a 1x liquidation preference and I'm participating, but I also get to then convert to my 10% commons, right? And I get 10% of that. So in the example I was talking about before, I own 10% of the company. I invested at $1 million. Company ends up selling for $5 million. Not only do I get my $1 million back, but then I get 10% of what's remaining. So I get 10% of $4 million. So I get another $400,000 on top. These are incredibly uncommon, right? If you have folks really pushing for participating preferred shares, like likely not a good deal. You should walk away. They're a little bit where they have started to get a little bit more common is in some of the later round deals in companies that raised during the height of the market. So during like 2020 and 2021. So you don't really have to worry about it. But one thing I will note is, yeah, if someone's really pushing hard for participating, yeah, please be wary of that. Right. Convertible notes. So Jonah, do you want to maybe talk a little bit about what is a convertible note and what does it do?
Yeah. So I think we talked a little bit about how it's related to some of the previous ones, but a convertible note is like it might sound, it's debt. So this is, I guess, kind of officially debt, but it's something that will has terms in it to convert it to equity in the future, right? So debt, the major difference, of course, between debt is that debt, like your mortgage, is something that you have to usually there's interest related to it, and there's an expectation that the person gets all their money back plus the interest at the end of the term. Where this gets a little bit different is that, and then it also has we're talking about the waterfall before, about how the preferred shares have a preference over the common shares. Generally, it's my understanding that the debt is usually the very first people to get paid. So it's the debt, then it's the preferred, then it's your common shares. And so if anything does go south during kind of between the period, that it would convert to equity, they would technically be the first people to get paid. But a convertible note will have the option for the investor to convert to either preferred or common stock, which means that they'll be converting from this asset that needs to be paid back to actually shares in your company. So you don't necessarily need to pay it all back like you would have to pay it all back, all the money back, or pay monthly payment or something like that. And so one of the benefits here, I think there's a few benefits in terms of just not having to have that equity out there at the beginning. You don't necessarily need to have all those discussions up front. But there is a little bit of complications because this is technically still debt. So there's interest and there's some conversations there. And then we do, to some extent, need to still figure out how we're going to convert this debt into equity later. How are we gonna determine the money that is now converting into in the future? And that's where this term valuation cap comes in. It's how do we say, is it just going to convert at the same rate it is in 5 years? Well, I mean, for example, if I was an investor and I was putting my money in a bank and I was directly converting, I wouldn't want to get just I don't know, what is the average rate of the bank right now? 2%? I wouldn't want to just get that for a relatively risky investment. I want to see if I can get if the company's doing really well, I want to see I can do better than that. But maybe I'll pass it back to Jesse for some of the more nuanced pieces of this.
Yeah, so I'll get into the valuation cap in just a minute because that's often the most important topic when it comes to convertible notes and safes, and we talk a lot about it, as well as the discount. I'm going to really explain some of the economic difference between the two. But a couple of important things to note here in terms of some of the issues. There's actually a few more that aren't listed there. But one of the things is, yes, that these people are debt holders, and they don't always have rights. So if something does end up going wrong, there is often stipulations in there that say they can call the note on you, right? So that's something to bear in mind, right? It is a little more complicated to structure. Sometimes there are additional terms that like to be put in there. I'll mention too, with the interest accumulation, is essentially what is happening with the interest accumulation is that sort of every day, as the interest is accumulating, you are losing more and more of your company, right? You're giving up a higher and higher percentage, because ideally the investors, when they invested on this, they want it to convert to equity. So they're getting their principal is growing, that's going to convert, which means that as it converts, they're going to buy more shares because they've set some parameters with the valuation cap that allow them to basically get more and more of your company over time. So when you're thinking about convertible notes, and when we think about them, this is one of the things that we think about is how does this sort of put the mental pressure on you as a founder to execute? Because they also do have a timeline, they have a maturity date. So you basically have 3 years is typically where we set them to try to hit the milestones that you've set for yourself with the valuation cap and with the interest and the amount of money that you've taken on. So so we keep talking about valuation cap. So here's where I'm going to bring in my colleague Neil, right? So valuation cap, complicated subject. It can be difficult to negotiate. There's a lot of back and forth. So how do we as investors think about the valuation cap? Because I know there's a lot of people think about it differently. But
yeah, and if you ask 10 different investors, they'll have 10 different viewpoints on it. But in essence, and this is a big difference between convertible notes, I threw it in the chat, between convertible notes and safe notes and a price round, is that it allows you to not have to put a tangible equity, like a tangible valuation on your company at a point in time. That's really hard to do, right? Especially for pre-revenue companies, just in the ideation phase, or even just slightly post-revenue companies. the actual like finite valuation of that company is likely going to be lower than you'd expect, which means that you're assigning too much equity at those early stages because you need money to grow, right? So that's sort of the risk associated with them. So the valuation cap for both convertible notes and SACE allows you to do like a rough estimate that's considered that's going to convert at a future round, which is typically the first equity round. You can set up all sorts of different terms in there. And then from the like trying to view it from the investor lens is they are trying to benchmark it against the other companies that they see and the comparables in the market, which is sort of the same methodology that you should do as you figure out where to value your company, right? So you have capital needs, you need to balance the dilution aspect, which we're going to chat about a little bit. You have capital needs, you have non-capital needs, and you need to make sure that you're offering a fair proposition for early stage investors, which to invest in a really risky company like yours, like which is fundamentally true at this stage in the game, to make it attractive enough for them to see a good multiple and potential exit return. So it's about like juggling all four of those different things at the same time, and then trying to land on a range that you're comfortable with. And obviously, when you're dealing with investors, start on the high side so that you have some negotiation room, and then figure out where you are comfortable and have honest discussions with them, because they see a lot of companies and be open to what they're saying, but also have like a line in the sand where it makes sense for you and doesn't make sense for you. So I know that's a bit of a vague answer, but that's sort of like the rough sort of process that I approach valuations as an investor, and that I advise that like founders also do as well. And then the discount and the discount or the interest rate and stuff like that are just like extra incentives to allow investors like a little bit more price certainty and to feel a little bit more like special for being early supporters of your company.
All right, yeah, we got a mirror.
All right. Very quick question. So when we talk about valuation cap, is it the valuation of the company like today as I'm negotiating with the investors, or the valuation of my company for my next, what I project to be for the next equity round?
Yeah, it should be a rough valuation of where your company is at today, but you don't see the actual equity and dilution until you have that price trend down the road. So like just using round numbers. So let's say you negotiate and get a convertible note with an investor today, and you put a valuation cap of $5 million in there. If your subsequent equity round is at $10 million, the investor, for X amount of dollars that they put in that $5 million round, convert to equity based on what percentage they should have got with that $5 million cap. And then if you raise at $4 million, then they get the discount on the raise too, to like, again, like incentivize them for being early supporters of your business. Does that make sense?
Yeah, it makes sense. Perfect. Thank you.
I'm just going to quickly, also just to add, this is really great explanation, thanks for explaining that to us. Just to add a little bit on here in terms of an understanding around economics from the VC and investor side, because this is a conversation that comes up a lot, and thank you, Amir, for that question. The reason why like VCs and sophisticated angel investors want to set that valuation cap approximate today is when I'm investing in companies, I want to see between a 2 to 3x, ideally 3x return between rounds of investment on your valuation. So if I invest in your company at the pre-seed round, it's 4 million. The next round, I want to see 12 million. The next round after that, I want to see 36 million, right? That's how I end up getting to sort of those big, 50x, 100x plus potential. That's sort of the trajectory that I would like to see your company go on in terms of valuation. In the event that I get, instead of the valuation cap gets triggered, but instead the discount gets triggered, and the typical number is 20%, but somewhere between 10 and 30 tends to be normal. We have started to see things as high as 50% because of the idea of not having down rounds. I can explain that in a minute, and if anybody wants to know. But say 20%, what I'm actually getting is a return of 1.25x my money, right? It's 1 over 0.8. That's the math, right? So I have gotten into arguments with founders a little bit before about, hey, I'm giving you this discount, you're getting 20% off my next round. How exciting is that? If the discount is getting triggered, it often means something wrong has happened, right? I don't want the discount to get triggered. I want the valuation cap to get triggered. And so that's why I want to set the valuation cap as an approximation of your valuation today.
Totally.
Right.
And not to keep piling on about it, but I like to think about it. If you're setting it for the next round, then there's no incentive for investors to come into this round, right? So I just wait until you de-risk yourself and 6 to 18 to 24 months down the road, and I'd invest in that at that point if that's sort of where you're pricing your valuation cap at.
So hopefully that kind of makes sense. Like I think it's really important as a founder is to understand like the economics of the people who are on the other side of the table. Like why are they making the decisions that they're making, right? Because if you understand that, you can negotiate better, right? Another really important one to think about here, and this is the economics as well come in, is pre-money versus post-money, right? When you're in a conversation with investors, make sure that you're having like you're asking them like, are we talking $10 million pre-money or $10 million post-money? Because you end up with a very different percentage of your company depending on which one it is, right? Essentially, what the difference is that like post money is giving me an exact amount that I'm going to have. So if I have a $1 million investment at 10 million post money, I know exactly what percentage of the company I'm going to have. If I invest $1 million at 10 million pre-money and you end up raising, $3 million, I could end up getting diluted or getting a lower percentage of the company because the sort of the end post of what your company is worth and the dollar per share changes depending on whether it's pre-money or post-money. All right. If you really want to understand all of this too, by the way, I highly recommend you check out the book Venture Deals by Brad Feld. It's a really, really good book to help you explain this, and it's written by a VC and a lawyer that became a VC that basically says like how as a founder not to get screwed by your investors. So recommend you check that book out, Venture Deals, Brad Feld. Go ahead, Amir, again. Yeah.
So does this mean that when we are conversation with investors, do they prefer to hear post-money valuations all the time rather than pre-money? So we kind of changed our language to post-money all the time as well.
Yeah. So investors will, especially with convertible notes and safes, we like to set it as a post-money valuation because what it does is it tells me exactly what percentage of the company I'm going to end up with when it converts. But it also protects me against you sort of what doing note or safe stacking, right? So if you end up raising more and more safes and notes, I still end up with that exact same percentage.
Yeah.
That's why I like it. Neil, did you want to add something onto that?
Yeah, totally. Yeah. But just keep in mind that for every like benefit to the investor, there's like a little bit of take, like for every give, there's a little bit of take on your side too, right? So from a founder's perspective, a pre-money is more valuable, right? So again, like all this is really subjective, but it's a good thing to try to like negotiate from a high point and to be like to negotiate in good faith with investors that are like excited about what you're doing and strategic investors as well as just not capital. But yeah, so just to make that point that these are the investor viewpoints, so they're really good to know. But it's also good to like understand the counterpoints to them as you frame up how you're going to go about your fundraising journey.
Perfect. Thank you.
Yeah, Joda, we mentioned there's some other side things, something called a side letter. And often that comes with this and information rights. Why don't you talk a little bit more about that?
Yeah, so I guess just kind of reiterating kind of what was said before, a lot of times, at least from what we see, like I think one of the most common ones that I think we see is the information rights. And this is just like, basically, it's just like, it's like, how do we legally say that you're going to be able to provide us some insight into what's happening with the company? Again, I said before, like it's a best practice as a founder to like be like very like be communicating with your investors at a regular pace, regardless of whether or not you have this letter. But this is just one of those ways that founders or investors can guarantee legally that they have some access to the information. And there's, I guess, a whole bunch of other kind of related items for where that can convert. But I think that that's probably the most relevant one. And the other ones, I'm not sure. It's probably on a case-by-case basis for the other ones. I don't know if I want to get too deep into that. And I see Annika has her hand raised.
Yeah, we got a question, Annika.
I'm just wondering if the investors like at Startup TNT ever consider the future raises and just making sure that valuation caps aren't too low so that when there are other raises done with venture rounds and stuff, that they're not looking at that previous raise and being like, okay, that's just way too low. Why did they ever go with that? I'm just curious on your thoughts and takes on that.
Yeah, so valuation, yeah, we don't want to set the valuation too low either, right? We also want to be bear in mind, like if you set it too low and say you're raising like $300,000 at $1 million valuation, like right, which would be an incredibly low valuation. The 30% dilution that early in your company life cycle would not set you up for success, right? Ideally, you should own about more than 50% of your company going into Series A investment, right? So for what they say is like post Series A, if you're around like that 51% mark, you've gone through those early sort of valley of death, as they like to call it, years unscathed, right? You've gotten, to a point where, you're still in the majority of your company, you're in a good spot. Neil, I see you came up mute. Did you maybe want to add some
Yeah, I,
thoughts?
I think you got it. Like, and from from an investor perspective, having a big valuation jump from round to round isn't a bad thing. So like fundamentally, your question is not like they won't think it's too low. That if you can justify a much higher valuation, that's a good thing. But the big concern, like Jesse said, is around the dilution and the founder's equity in there. So there's like some predatory investors out there that try to like take much, like we saw a company where a friends and family round had taken 60% ownership in a company, and they're uninvestable going forward, despite the fact that it was a good founder with a good product and stuff like that. Because like if you look up to Series B, that founder will be down to like single-digit percentage ownerships, and then obviously with the liquidation preference and stacking, their incentive to keep driving the business forward is relatively low. So that's the big concern about too low of a valuation.
And I think conversely, if your valuation's like way too high, that's going to also be like a flag for future investors, for future investment, right? So it is really this balance. And at the center of it really is you, the founder, who has the equity. How do we make sure that you have the right amount of equity in the future rounds so you're incentivized to continue to build your business and not like stuck with nothing with that? Because that's like, that sucks and that's not good for anyone, including the investors, because you're the one who's driving the bus. But also like trying to like manage, not being a massive red flag because now you're on a down round, but also not doing it so low that you get diluted out of the company.
Yeah, it's been said. But to your question specifically, Annika, more than valuation, it's percentage ownership in the rounds. It's how much are you going to own at the end of each round? And I think the rule of thumb generally is it's okay if you're doing the classic like friends and family, then you do pre-seed, seed, and Series A. If you're doing at pre-seed and seed, if you're doing 15 to 25% dilution, that's typically you'll be okay at that Series A. But if you're doing much more than that at any round, there's going to be a problem. And then the VC, they don't actually the value on the safe is not so much like a VC is not going to be scared of that, but they may ask you to go back and renegotiate with your existing investors to make sure that when they invest, you're not overly diluted, because that will be it's not the valuation, it's the ownership. That will be the point. They say, well, we'll invest so long as you're going to have at least 25 or 50%, whatever round you're in at the end of this round. So then it's going to be incumbent on the founder to go back. And those are not easy calls, to go back to an investor and say, we want you to take a discount to what you've already agreed to 3 years ago. So that's not an easy call.
Yeah, just one last thing on this, right? And in terms of how you should be thinking about it, and I get into this in a later slide, is thinking about as I mentioned, those 3x milestones, right? So if you're setting your valuation today at 2.5 million and you're raising, maybe up to $400,000-$500,000, is that $400,000-$500,000 going to get you to a point where you can justify a valuation of 7.5 million, right? 3 times higher than where you are now, right? So that's what you really need to like sort of back, like if you're going to do the math, is like, okay, so I'm going to take this $400,000, I'm going to spend it on X, Y, and Z. This is probably going to get me this much revenue. In my comparables, they get a valuation multiple that's like 6 to 10x their revenue. That justifies a valuation of X, right? And that's sort of how the really simple version of the formula that you can kind of leave in your head to think about, how to put those numbers together for today, so that you set yourself up for the future. One thing, just quickly before we bounce over this, because we talked about this on the safe as well. With convertible notes, they can be set up a couple different ways. Either they'll convert to commons explicitly, they'll convert to preferred shares explicitly, or they'll convert to whatever the next round is above a certain qualified equity financing threshold. Meaning you have to raise at least $2 million of equity priced equity, and I'll convert to whatever that person negotiates. Right, that's what will happen on a convertible note, and very similarly can happen on a safe. Because we've covered so much on the convertible note, we can really, I think, kind of jump through the safe pretty quickly, because essentially a safe is a convertible note with no interest, right? It isn't debt, right? So it's a little bit different. It sits sort of what's called like off the cap table, but it is still on the balance sheet. People say like it's off balance sheet. It is on balance sheet. There are two sides. Money comes in, so you got to have it on the other side of the balance sheet. But essentially, it sits off the cap table. I'm sorry, just something in the chat. Yeah. So, any other important notes here, Neil, that I should mention on safes relative to convertible notes? Maybe you want to.
No, and yeah, the only the only notable thing is like as we've gone through these, we've gone from like the most legally complex to the least legally complex, and the whole. And so YC started up as a way for people to. I just put a link in the chat that you can go and you can download the YC safe. Most of the safes that we see are like a variation on the YC safe. There's a few other ones out there, but it's like legally in terms of expense, it's a virtually free way of getting getting an agreement together with an investor. So as we've sort of walked through equity to convertible note to safe, that's been sort of the process that we've gone through as well.
Yeah. And so the same with this one, very similar valuation cap discount, pre versus post money. All those things come into play in the conversation around these. Same thing with converting. The one thing I will note there, the optional conversion structure. I think we've done it once or twice, but typically safes will only convert in the event of a qualified equity financing, right? Which I had mentioned before. But there sometimes could be like maturity dates or triggers on that. We've also had, for example, you can get a little funky with safes. Maybe there's like a trigger. We've often used safes in the event that, say, you're negotiating with a VC on a price round of equity, which requires all this extra time and complexity. But we want to get the deal done. We want to invest money in your company. There's a couple $100,000 on the table. You want to take that money and start using it. So we'll put together a safe with no discount that will then at first, but eventually we'll get a discount in the event that price share deal doesn't go through. Then we get the discount in the event that it does. We just convert basically right away to that price share. So it's basically allowing us to get the money into your company without having to do all that extra work. So this is where safes can be really useful, is being able to like get those deals done quickly while you're still figuring out like something that's more complicated. And I'll explain what's called an MFN in a minute. Most favored nation clause. That's also helpful. I'm just going to look in the chat here.
We got a question from Fred there.
So
Yes, absolutely. You should show the safe on your cap table. Ideally, you should with showing the safe on your cap table, you should be showing the valuation cap that's on there, the discount, how much was invested on that valuation. And then you should have your cap table set up so it does show what happens in the event that converts, and how much dilution that you would have, and you and the other members of your founding team, your employees, your share option plan, how much percentages that ends up with after all of your safes convert, right? So that's all really information to have. Neil?
I think one thing, Jesse, I just want to make sure before you go too far on the convertible notes. Did you explain the difference between a secured note and a non-secured note?
No, but we don't really see that very often.
Well, yeah, it comes up. It does come up, and you'll have some of us on the convertible note. Just so you understand, there is a thing like there's a prioritization, like there's senior secured, senior convertible, and then convertible. So there's a prioritization. And what secured notes mean is if you get into a situation of things aren't going well and you're gonna liquidate the company or sell it at a valuation below the total enterprise value, if you add up the equity and debt, then the secured pairs, they actually have a position against the assets of the company, and that could be the IP of your company as well. So just so you understand what that is, and you can read about that, secured versus non-secured. And when I was raising for my startup, the lead for us, and then TNT had the option to participate, it was a secured convertible note. So that is actually, it does come up.
Okay. Yeah, that was what Jonas was talking about earlier with the sort of like liquidation waterfall when it comes to the company's dilution. Neil, over to you. Yes, on this topic.
Totally. I just wanted to follow up on Fred's comment. So, like technically, because you haven't issued any equity, the safes don't need to be on the cap table from a formal sense. But it is a good practice to make sure that investors have all the details that they need, especially if you have multiple safe stack, because you can't. And the other caution, especially in like today's market where down rounds are not uncommon and stuff like that, what you're expecting for dilution, if something doesn't hit the exact cap or at least 20% above the cap or whatever your discount rate is too, it can really impact the potential dilution down the line too, right? So again, like your cap table should technically just have issued equity and where it's being allocated to and any warrants and options. But it is good to provide that. I'd like to see like a clean cap table with actual issued equity, and then like another table that shows like the unissued equity, like warrants, options, safes, and notes that are outstanding, so investors can easily model out what that could look like in a bunch of different sensitivities. And then Amritza has another great comment there too. Is yeah, there's a lot of non-dilutive folks that have a bunch of requirements around equity raises, the well forms, including safes, yeah, or equity or convertible notes or.
Yeah, SUTC doesn't use convertible notes. It doesn't allow convertible notes as doesn't qualify for their thresholds, right? And so that's also something to bear in mind. One of our frustrations currently with the Manitoba tax incentive system is they don't allow certain forms of investment to qualify. I believe it was only common shares. Gloria can correct me in the chat.
Yeah, it's only common shares at this time, or I guess we should say a priced equity round. That's the only one that qualifies for the SBVCTC, and further to that, it can only be offered to individual investors. In the case of Startup TNT, where we use a flow through limited partnership with where all of our angels are currently sitting, the tax credit in Manitoba doesn't apply there either. So just a little heads up for those that are joining us in this round in Manitoba.
Yeah, thanks, Gloria, for giving us the insights there.
Casey has a question about it.
Yeah, please, Casey.
Excellent. I think I can make this question more general. I'm just curious if everything about when a safe converts is the same as anyone coming in for a round for the purposes of anything else legally. So SBV, sorry, terrible at that acronym. The Capital Tax Credit Program. When a safe converts, do those same things apply in the same way, or is it considered a different type of transaction?
So that is a really good question, and a question we've talked with the SBVCTC folks about. Let me put it this way. The act is written to allow for that. The regulations are not. And they're also still deciding whether they're going to allow retroactive investments to be approved for the tax credit should they raise a priced round in the future.
Perfect. Thanks. That's good enough.
Yeah, I don't know if I could say that 3 times fast, Gloria. You railed that off so quick. Love it.
I only talk about it all the time because this is an ongoing issue that we're lobbying with the province for to make changes, so that when groups like Startup TNT and angels coming into them want to invest in local companies and take advantage of the tax credit, we want to see that, be a thing that is allowed. And so there's been an ongoing conversation about how this is beneficial for founders and angels and the province to get moving on getting the act and the regulations to align.
Awesome. Thank you. We got 10 minutes left. I think we can go a little long if need be. We are recording this. I got some time after this to go a little long if we need to. But just quickly to run through some other important terms. We mentioned information rights before, but we've got a few other important ones there. Neil, you want to just tell us about MFN, dividend, liquidation. Well, we talked about liquidation already.
Totally, yeah. Yeah, I'll run. So most favored nation is something that we see quite often. So especially for a group like Startup TNT, or if you have other angels or friends and family, it's a good clause for them to have in. So what it in essence means is that you're going to establish deal terms early on, like rough deal terms, but they have the ability to use the most favorable deal terms as the larger part of your round, as held by your lead investor, right? So we see that even from different types of instruments. So we have invested safe notes into companies early on in their fundraise as they are trying to negotiate valuation and close an equity round, and then we convert to that equity round on those terms of that thing or at that time, or it can be in line with any of the other types of investment vehicles. So if we negotiate a safe with a $6 million cap and we have an MFN, and you find a larger investor and they do a safe at a 4 million cap, then we would roll over to be on the same terms as the investor there. Just keeps everybody on the same playing field, keeps it easy for you to manage your cap table, and keeps it equitable for the investors as they support you early on. Dividend clause, safe and note, that got instituted a couple of years ago by YC because there's a few horror stories out there about early stage investors investing in safe notes, and then those companies going out and kicking ass and building a company on cash flow and never raising an equity round. So they never converted. So they invested early on in these companies, but they have no way to get their money out. They're like 20 years on. There's even like a couple unicorn companies out there that have investors that have not been able to get their money out. So this clause got added as an organization, despite the fact that safe and note holders don't own any formal equity in the company, they would get royalties, dividends, and stuff like that that gets sloughed off by the company to their shareholders as a way of making it a little bit more equitable. We talked about liquidation preference. Warrants is kind of a niche thing. I don't know if we want to touch on that here, Jesse. But is there any other ones that? Pro rata is probably another big one to chat about as well. So pro rata rights are really common as well. And that is a way for investors to maintain, to minimize their dilution and to be able to maintain the right to invest in subsequent rounds. So if we invested in you at an early stage and you're going out and you're doing amazing things, which is exactly what we want to see, and you get a VC that's super exciting in your next round and they want to carry the whole round without a pro rata agreement, you would have no legal obligation to allow us to invest in that round and for us to like keep being part of the story. So pro rata agreement allows us to maintain the equity stake that we had at the prior round in subsequent rounds.
Yeah. And then I'll mention vesting there at the bottom. One of the reasons I bring up that term is it can also be negotiated with you, especially during larger price rounds with institutional investors, is that they'll take some of your shares as a founder and they'll kind of lock them up and give it back to you on a schedule called a vesting schedule. If you want to understand a little bit more about that, yeah, recommend doing some research, chatting with your lawyer. But just something to be aware of that can happen. And we've certainly seen that before. I mentioned this earlier, but yeah, this is where it's important to really think about, where you're going to be in a few years, that, the triple or double that we want to see between rounds. What they really actually like to see is sort of like triple, double, double. That's what they kind of call, that's sort of the typical VC trajectory. So if you're able to follow that, and so as I mentioned earlier, think about where you're going to be, where you need to be in a few years with the money that you're going to get now, and are you going to be able to hit those milestones, and are you going to have enough runway, right? Like, so something's really important here to think about is, can you raise a big enough round that you can go for quite a distance, right? Because right now it does take a long time to raise. We are still in the middle of this. I'm listening to podcasts and hearing news about, it'll be 2025 before things might go back to normal in the venture capital world. So think about how much time do you need to really get to these milestones? Because maybe, how long it's going to take you to sell your software into a large enterprise is going to take twice as long as you think it is. So make sure you've got the resources. And if you've got like a hot story right now, right, take in as much money as you possibly can, right? Like when you've got the hot story, take in that money and find a way to make it work, because that it isn't always going to be the case. You're going to have moments in your company where you're not going to be as hot as you once thought you were. So important to keep in mind. Yeah, we kind of covered these already, so I'm going to kind of skip ahead. We did talk about the dilution a bit, so I'm actually going to skip over to this because I know people really wanted to see this part. So we'll get back to the dilution because we did talk about it a bit already, but we can go into it if anybody really wants to go into it after we hit 11 o'clock. So deal stats. So people have to talk about like the valuations, how much folks are raising, what's our size of check here at TNT. So these are the stats basically for the last 18 months since the VC market took a turn, right? So at our height of the market 2 years ago, 2021, we had different valuations, different round sizes. We did our biggest ever round ever, our check ever into a company 2 years ago. That's all changed a little bit, but this is where we're at with a median valuation about 6.5 million, and I'll break some of those numbers down in a minute. As you can see, a lot of safes. We're doing a lot of safes, but we are doing some common share deals. We're seeing a lot of those as well. Typically, with the common share deals, it's where there's been a bunch of investment done already on the deal. They've got a lead investor in place that set the terms, and then we're just following in on those terms. Yeah. Oops. Whoa. Why did it do that? There we go. Okay, so this is over the last few summits. So I've got an average winner valuation because we don't have we only have like a handful of winners in each one. So doing a median is weird, but so I did an average. And then we've done the sort of the median deal valuation. So you'll see there's quite a range. If you look at understanding what this data says, essentially is that often the winners are a little higher on the valuation because what that meaning is they're typically more of a late pre-seed or a seed round company. They've done a little bit more to de-risk. But that said, what the median deal valuation shows us is that we are still investing in the pre-seed companies. We're just investing in them typically as side deals. We're not seeing as many winners getting the with the lower valuations. Yeah, overall. Sorry, that said that in a weird way. Neil, anything else to add here on valuations that we've been seeing over the last?
No, I think you got it covered there, Jesse. That's good.
Yeah. So yeah, when you talk about the statistical scatter, I think this table here really shows the range. So as you can see, we're going from as low as 2.5 million in the most recent summit up to 14 million. So there is a big range of different valuations, and these are the ones that actually got done, right? So these aren't just valuations that we saw; these are the deals that got done. There was everything within that range on valuations since Q2 of 2022. So Summit 5 was in Q2 2022. Summit 6 was a year ago. Summit 7 was in the spring. And then Sector Summits was back in Q1 of this year. Sector Summits is typically more hardware companies. We saw quite a range there with the various companies that came through and saw some of our highest valuations. Yeah, and then in terms of like check sizes, we are seeing basically around that $200,000 mark for our winners, and then we're seeing everything from $25,000 up to 150,000 in side deal money going to our companies as well. So quite a range there possible, even if you don't win. And then here is the sort of regional breakdown of the valuations. As you can see, our highest valuation market is Calgary, and our lowest valuation market is Manitoba, and then you got Saskatchewan and Edmonton in the middle. And that's, I think, sort of emblematic of what is happening in venture capital across those three markets, because a lot of the valuation question is also dependent on supply and demand, right? If you've got more supply of venture capital firms and venture capital in general, the valuation gets bid up a little bit more. Not only because there's sort of a bidding war happening, but also because you need to have a larger valuation to raise a larger round, right? Because we talked about the dilution earlier. So if you're going to raise a large round of capital, then you need to set your valuation a little bit higher. Adrian, did you want to add something in here about what's going on?
Yeah, there's I mean, everything's multifactorial. Everything depends, right? But they're fundamentally the more capital there is investing in venture, there seems to be a direct correlation to the valuation of companies that do deals. At the same time, it could be also that the deals are coalescing around higher valuation companies. So there's two things going on at the same time, right? You have, and so people always come to us in the summits and they say, if I were raising in Silicon Valley, I could be a $40 million company. And I'm just using some random numbers. But the reality there is there's way more capital, but and the likelihood that you get that deal though is probably the same or lower because you've got way more competition, way more deals. So as much as those deals are coming at higher valuations, there's way more of them. So there's as many percentage product wise, there's as many or more deals not getting done. So it is a tough thing to navigate, but I'd say these are good numbers to understand, but there is a statistical spread on everything, right? There's distribution.
Absolutely. Yeah, so we are at the end of our time here, but happy to continue going and take more questions and talk a little bit more about dilution, which we kind of skipped over. But does anyone have any questions about valuations? What, how to find the valuation? Want to understand this data a little bit better that we just went through? I know we just dumped a lot of information on all of you guys, so I understand if folks are a little overwhelmed. Yes, please.
So you were talking about 2 to 3 times increase in valuation between rounds, and you're saying you have to meet your objective. So if the money you're raising in your current round gets you X, Y, and Z, and that gives you some jump in revenue or revenue to start with, then you're going to apply basically a multiple to determine what your valuation is at that next round. How do you think about what that multiple is? Because variation in that multiple really affects how you think about that math.
So the you can look these multiples up a little bit on like PitchBook and Crunchbase. I believe like sometimes you're able to see these. A lot of it sort of starts from the public markets and comes down from there in terms of the multiple on their revenue. What we see is it's usually somewhere in the realm, especially with sort of like your B2B SaaS, somewhere in the realm of 6 to 10x on your revenue. That number can go up dramatically. Say stuff in the AI space, I think has been seeing things as high as 20, 25x. If you've got a lot of IP, if you're like, truly revolutionary, that will affect that multiple. And yeah, I think it does have a lot to do with where, what returns that you can get, but it's not an exact science. I'll say that it's definitely an art.
Well, let me say this. Let me say this, because I think this is important. For every startup founder, like if you don't think your business is a company that can do 2, 2, 3, really think hard about whether venture and venture capital is where you should be raising. Because the 2, 2, 3 really is driven by VC return requirements. And so if you don't think you can hit VC return requirements, you might not want VC on your cap table because they're going to drive you to get 2, 2, 3. So think about that for yourself. Like, where do you raise money? Should I bootstrap for longer? Should I just be should I be just grinding this thing out because there's no way I can be 2, 2, 3 in the time requirements that VC have? I know Neil's probably got some perspective there too.
Yeah, totally. I was going to say the same thing. Like fundamentally, I think it's also important to understand that the reason that VCs are looking for this is because they're investing in a super risky asset class that's going to see 60 to 90% of these companies return less than the amount that they invested in. So in order to in aggregate across the portfolio, make risk-adjusted returns, which is ever increasing as interest rates go up, they need to be able to invest into companies that have that moonshot potential, that hockey stick curve growth. And that's why you need to that's why that sort of 2, 2, 3 model is in there, because that sort of is that exponential growth curve that investors are looking for. So it's good to understand that context in it. So again, but this is just in VC. There's a ton of folks that like fall off that narrow bandwidth, even in the venture world, but especially in other types of investing and stuff like that as well. But yeah, this is all generally true. But I just wanted to add context to Adrian's point about it as well.
Yeah, and there's noise around that, right? Like 1.5 to 3.5. Like there's noise in that 2, 2, 3. Is just something to think about as a rule of thumb.
Yeah, and I'll also mention here, like as TNT, like we've done deals that are venture capital, and we've done deals that are more like private equity. You're gonna get to a point where you're gonna start kicking out some cash and dividends, and we're gonna make money that way. Like we are, positioned as, a venture capital type organization, but because of the variety of different things that we see and the different innovations, sometimes during the process, when we're chatting with the, folks, we start to realize maybe the market size isn't big enough, and the potential for this isn't that you're going to be $1 billion company, but maybe you're going to be $100 million company that's making $10 million a year of revenue with the $2 million of profit, and you're able to like take that profit and kick it out to people, right? So like there are different deal structures, and so that's also where the conversation comes in as we get into the top 5 stages. What's the deal structure that is appropriate for you, bearing in mind the potential of where you're headed, right? And so we'll talk that through with you in the event that you make it into that stage. That makes sense. Yeah. Yeah, we did skip over dilution a little bit, so maybe I'll just go quickly back through that. Neil, we put together this awesome little example here. So why don't we kind of walk through this quick on what this means with dilution.
Oh, so this is just a super simple example of like the impact of dilution and what an equity raise looks like. So this is based off of an equity raise. So I don't need to read this all out to you folks, but assuming you had 3 million shares before the raise, of that the founders had 2.6 million of them. That gives them the equity of 86. If you go out and you issue another $1 million shares, and those founders don't increase their equity stake through that raise, then the equity, as you can see, gets diluted to 65%. So this is just like a really like simple way of visualizing what happens when you issue additional equity. Is you got to keep in mind that your like equity stake stays static unless you take active measures to prevent that. So you will get diluted down every time. So in this case, they added they added a third more shares, and that diluted the founders by about 20% at this stage. So the next slide has a little bit more sort of complex way of viewing it. And again, I won't read this out to you folks, but you can see that founder 1 during this raise invested some, I'm assuming money, or figured out some other mechanism to get 250,000 of those extra $1 million raised, or million shares issued. Sorry, I got a cold, so my brain's a little NyQuil'd up. So you can see that he managed his dilution by doing that, and then you can sort of see some of the impacts with the remaining option pools and the issued investors and their sort of equity stakes as it turns out too.
Yeah, and one of the reasons this is a good example with the Series A there, one of the things that could have happened here is where the VCs who invested made a point of topping that founder back up again in some way, because they, as you said, like we want the founders to have a good amount of equity, so you're highly incentivized to keep going. And so what can happen at later rounds is you can see top ups of the founders, some sort of vesting schedule that get put in place for them. You could also see examples too of what we call secondaries, where the founders have some of their shares bought later down the road because maybe you want to get a little bit of money so you can go buy a house because you've been living off noodles and ramen for the last 3 years or 5 years, 6 years, whatever it's taken you to get there. So those are some things that can happen. What's really important here too is to like making sure you're keeping in mind the pool, the option pool in your dilutions, right? We often see people forget about that or miss that. And of course, we talked earlier about the safe stacking. So when you're doing your projections on dilution, especially around the Series A round, because we often see pre-seed and seed rounds are done on convertibles. Make sure you're keeping in mind, the various valuation caps. Make sure was this a pre-money valuation cap safe or a post-money valuation cap safe? Because that changes the calculator and how it's going to do the math. So all of those things play into dilution. And yeah, rule of thumb, 20% is about the number you want to be thinking about with dilution.
Yeah, and
I think
keep in mind, this is just one race. Sorry, Jonah. This is just one race. So like we talked about earlier, is you want to sort of map out like how many raises you're going to need, and obviously there's a lot of variability in there. But this is a good snapshot example of the impact of one raise, and then you can sort of like work out what the impact will be in subsequent raises in terms of dilution as you again like build your fundraising plan.
What I was going to say was, like, there was a question in the chat about like exit strategy, and I think that Jesse talked about the different types of companies, and whether you're, or I think Adrian as well, whether it's you're a venture style company, or where do you think you're going to go? Where do you aim to end up? And I mean, maybe everyone's dream is just to IPO, like Facebook or Meta or whatever they're called now is, but that's not necessarily the only strategy, right? So it's like you could get acquired, you could IPO, and I'm sure many have thought about this, but kind of the way, like this table and how this works out will also kind of define where that is along the way. Like if you plan on getting acquired, maybe you don't need to make it as far as somebody who would go if they're being IPO'd, but the value that you're going to be able to create if you're getting acquired is probably usually less than an IPO. So like that will probably play into your math here in terms of what you need to have and kind of how this needs to work out to get to that point where you want to get.
Okay. Any other final questions? We've got a lot in the chat. There were some great questions. Thank you for everyone who was asking the questions, but I know we've gone over. Maybe I will just stop the share there. And yeah, well, thank you, everybody. Feel free to reach out to your regional leads. We had, Manitoba, Gloria here on the line, Calgary, Adrian here. There's Lindsay up in Edmonton and Mike here in Saskatchewan. Of course, Neil, Jonah, and myself are also open for conversations. We're all here to be helpful. Great place to talk about this is at the happy hour. We got happy hour tonight in all 5 cities. So please check that out. Hopefully we'll see you there at one of the happy hours in Saskatoon. We are with Collabs tonight, so make sure you have your tickets to the Collabs event. With that, I will leave it there. I don't know if there was anything else. Neil?
No, have a great day, everybody. Thank you for coming.